There are many economic indicators, some of which are more useful than others. We must keep our eyes peeled for new data as it becomes available and constantly add it to our knowledge base in order to keep up with the rapid changes of our environment. There are many indicators which specifically highlight whether a stock is overvalued or undervalued, and much of the information is debatable. In this case, we will look at one of the best ways to determine whether a stock is overbought or oversold. You came here for the truth, so let me unveil that for you. Today we're going to break down exactly what the RSI is. I'm going to get into it in full detail, and we're going to look at this in a very simple manner. I'm going to show you some charts. I'm going to give you the full explanation. So let's begin by taking a look at Investopedia and what they have to say about the Relative Strength Index. The RSI is a momentum indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. The RSI is displayed as an oscillator, which is a line graph that moves between two extremes, anywhere between 0 and 100. So this is the basic definition, and I'll show you a little bit more about that. Signals can be generated by looking for divergences and failure swings. RSI can also be used to identify the general trend. So this is the chart. If you see it here, look at the bottom. That's the RSI. If it moves above 70, it is considered overbought. If it moves below 30, it's considered oversold. Of course, as I mentioned in the introduction, this information is debatable, just like all other indicators. And I must stress the fact that this is simply one indicator of many. No indicator is a tell-all signal, but it does help, and it is very, very useful and tends to be very accurate. This right here is a recent example from early 2019. You can see what has happened. I will highlight it for you here. Looking back previously in October of 2018, right here you can see the RSI of the S&P 500 moving down into oversold territory. The same thing happened towards the end of 2018 again. We saw that occur, and then of course it moved above into overbought territory as of the beginning of February. I just wanted to give you a real world example of exactly how the RSI plays out in relation to a particular stock or an index or what have you. Now I want to break down all the details of the RSI in relation to what you need to be looking for. Wilder, the creator of this particular index, believed that when prices rose very rapidly and therefore momentum was high enough, that the underlying financial instrument or commodity would have to eventually be considered overbought and a selling opportunity was possibly at hand. Likewise, when prices dropped rapidly and therefore momentum was low enough, the financial instrument would at some point be considered oversold, presenting a possible buying opportunity. It's pretty simple in this regard. Of course, there's more detail on that, but I just wanted to give you the basics here. I think it's important to look at the RSI on a daily basis, to track that when you're looking at a particular stock or index, to give you an idea of what's happening. There are set number ranges within RSI that Wilder considered useful and noteworthy in this regard. According to him, any number above 70 should be considered overbought, and any number below 30 should be considered oversold. So that was the range that I showed you, and 50 is considered no trend. In the following paragraph, they basically just suggest that these numbers could be as low as 20, could be as high as 80. It depends on the individual and how they look at it. But I just think it's important to understand the relative strength index and how that plays out in the daily events that we see. We looked at the stock market coming down from October into November and then December, and it was very clear that despite despite all of the fundamental issues that are presented, we had a definite oversold condition that was taking place. Many people were selling off, and this was from the hedge funds, the institutions. We saw all kinds of different corporations basically heading for the exits in particular stocks or even certain indexes, and that started to weaken further and further and further. It got to a point at which they started to become a buying opportunity. The trading algorithms picked up on this information and started to buy, and that's really what this shows us with the RSI. I don't want to get into further detail about this. I think it's enough just to understand the basics. If you look into something into such detail, it may just make things worse because it's only one indicator. It can't tell you everything. It cannot explain all the details from top to bottom. There is no way that a comprehensive analysis of one particular indicator is ever going to tell the picture better than knowing hundreds and hundreds of them and keeping an eye on them on a regular basis. That is always the best thing to do. I'm going to finish the video there. This is part of the Money GPS free e-course. I hope you do appreciate this kind of information. If you do, please give me a thumbs up. If you're interested in more free videos like this as part of the e-course, you can check that out at themoneygps.com. There's also a playlist here that will go through all of those videos. I have hours and hours of content really just explaining all these different indicators and different things to look out for. Now, if you found this video informative, I know that you'll find my books even more informative. I get into all kinds of detail, talking about making money, foundation, asset classes, even reducing your expenses, and so much more. You can check that out at the link in the description. And if you want the audiobook version, you can get that at themoneygps.com.